Hello everyone, welcome to JIB CIB English Medium. This side Aarti and I hope you all are doing good. So if you are also preparing for CAIIB June 2025 cycle, then this series is very important. You can share with your friends and colleagues also who are planning to give this CIB 25 exams. Because in this we are covering concepts, and based on that concepts we are covering MCQs and numericals also. So with this, without wasting any time, we are starting this session, but don't forget to subscribe to our channel and don't forget to share this channel so that more number of bankers can take this free YouTube session classes. Chaliye. So with this, I'm starting today's session. So today we are going to start Unit 14. Okay, Unit 14 talks about discounted cash flows. So already we started your module C. In that we have seen your Unit 13. Now today we are going to start your second unit of your module C, that is discounted cash flows. Means basically we are going to understand how to value the things with the help of time value of money, because a rupee you are going to receive today is more valuable than you are going to receive a year later. So when we are talking about any company, and if they want to acquire any other company, or as a company they want to sell their business, so how they are going to value? What is the perfect calculation if they are considering this time value of money? That is what we are going to see. Discounted cash flows. Cash flows, what you are investing and what you are getting. Okay, suppose I want to start a business. So I am investing 10 lakh rupees and yearly I am receiving 2 lakh, 2 lakh, 2 lakh. So that is the direct figures I am saying. But I need to consider inflation part also. I need to consider economic, micro and macroeconomic factors also. So I need a true valuation, though I cannot predict exactly what will happen. But I need to estimate with the help of time value of money. So when I am estimating with the help of time value of money, all the cash flows, because today's time period cash flow is not required of any time value of money. Whatever I'm investing, that is my present. But what I am going to get after 1 year, 2 year, 3 year, I need to adjust with the help of time value of money. And for that, I need to use discounted cash flows. So we are going to see again in this unit, don't worry. So basically discounted cash flow, you can say DCF, and it is a valuation method. It is a valuation method through which you are going to understand, or you are going to estimate the value of any investment using its expected future cash flows. Expected future cash flows. After 1 year, 2 lakhs. After 2 years, 2 lakh. After 3 years, again 2 lakhs. But what is their true value? So that I need to adjust with the help of time value money. So analysts use DCF to determine the value of an investment today based on projections of how much money that investment will generate in the future. So generally when we talk in layman language, we are not including any inflation or any part. But if we are having knowledge, if we are professional analysts, then we need to consider this discounted factor also. And when you are considering that time value of money, you are calculating DCF, discounted cash flow. Now, next thing in this, we are going to talk about over a graph. This is a timeline. Suppose I am starting one business today. Okay, today I am investing 10 lakh rupees that I told you already. This is my cash outflow. Okay, 10 lakhs I am investing. And with this investment amount, I am going to generate, this is my suppose first year, I am going to generate 1 lakhs. So let's take the same figure. Suppose I am generating 2 lakhs. Suppose I am generating 2 lakhs. Second year again same cash flow, 2 lakhs. Third year again same cash flow, 3 lakhs. Again same cash flow, 2 lakhs again same, 2 lakhs, and again same 2 lakhs. Correct? These are my cash flows that I am going to generate with the help of this invested amount. But this after 1 year, 2 year cash flows are not adjusted as per different factors. There will be inflation, there will be some different economic activities. So I need to adjust all those things, that microeconomic factors. So when I'm actually adjusting, in that I am using discounting. I am using discounting. So when I am valuing this cash flows with the help of discounting, then I am getting DCF, discounted cash flow. Now, how to calculate this DCF? We are going to see, don't worry. But remember, whatever investments we are going to get, or suppose if I am purchasing any new business, in that I am giving 10 lakhs, and with that business, I'm going to generate 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh. But this is not after my inflation. This is not after my different factors. So as a true analyst, as a true person, as a person who is having a knowledge about this sector, they are going to discount it. They are going to give the effect of time value. Okay? So basically, how to calculate this discounting part, we are going to see in this unit. Chali. Next, key points of DCF valuation that include: first, present value concept. Present value concept means whatever incomes you are generating, 2 lakh, 2 lakh, 2 lakh after 1 year, after 2 years, after 3 years. Then what is their value at today's time? If I want to know their true value, because I already told you, a rupee invested today is more valuable than a rupee invested after 1 year. So what is the true value that I need to understand? Okay. So when I am discounting this and I am calculating for 0 time period, because this is after 1 year, this is after 2 years, 3 years, 4 years, and 5 and 6 years. But when I am calculating with the help of discounting, I am getting the true value. That is what present value concept is. So the value of any asset determined by its future cash flows adjusted by time and risk. That is the present value concept. Then risk and discount rate. So discount rates are used for calculations of your discounting, in which you can see higher discount rates are applied to riskier assets and safer projects use lower rates. Then next you are going to see intrinsic value. Now this estimates an asset's intrinsic value, which reflects its true worth based on its fundamentals. So basically, intrinsic value is the value of neutral analyst would assign based on accurate cash flow projections and an appropriate discount rates. So after your calculation, whatever amount you are generating, that is your intrinsic value. After you have given all the risk and discounting factor adjustments, that amount you are generating, that is your intrinsic value. Then expected cash flows. Number 1 is your free cash flow to equity. Next is your free cash flow to the firm. When we are calculating the free cash flows to equity, means the equities are the persons who are sharing the ownership. And so whatever amount is available to equities only, to the owners only, that too in a cash form. That is what free cash flow to equity. Now in this, you are going to exclude the debentures, their interest, bond interest, and the true value that is available for the equity holders in the form of cash. That is calculated through free cash flow to equity. Then next we have free cash flow to the firm. Whatever amount is left for your equity holders, your debt holders, your preferred stock holders, to your all claim holders, whatever cash you are holding, that is your free cash flow to the firm. Remember, for the firm, you are going to include all the holders: equity, debenture, preference. But in case of equity, we are going to talk about only equity, about your owners. After paying all the amount your interest holders, debenture holders, preferred stockholders. So these are the two expected cash flows. So first is your free cash flow to equity. Next is free cash flow to the firm. Now, next, discount rates. So discounting determines the present value. Already we discussed this, that present value of future cash flows. We by using a rate that is cost of capital most accurately reflects the risk and timing of the cash flows. So that is what discount. In this discount rate, we need to use the two perspectives: default risk and market risk. Remember, this discount rates are used for calculating the true value of your money that you are going to receive in your future. That is what discount rates. Okay, so these are the terms that we need to understand before solving this calculation or this methods. So discount models are divided into different models. Firstly, we are going to see the dividend discount model. In that we have constant growth model, zero growth model, two-stage H model, and three-stage model. So basically, today we are going to start with constant growth model. Now, constant growth model says that as a holder, you are receiving dividend, and that dividend is increasing with the constant rate. Suppose, as an equity holder, first year you are going to receive 5, then next you are going to receive plus 10%, plus 10%, plus 10%, plus 10%. Means whatever you are going to receive with the constant growth percentage. That is what constant growth model is. So one of the most common assumption used by the constant dividend discount model is that dividend paid out per share would increase at the rate that is fixed. We are going to see fixed increase in our interest rates. Then we are going to use constant growth model. Suppose as an investor, I want to purchase Reliance company shares. Okay, and per share is ₹100 right now, and they told me that I'm going to receive 5% dividend, and this dividend will grow yearly the help of 10%. Means there will be a rise in my dividend every year. That too by 10%. Every year 10% increase I am going to see. So if that is given, some fixed growth is given in my dividends, then I am going to use this formula, constant growth model, in which D1 is divided by R minus G. G is your growth. G is your growth. Okay. R is your rate of your dividend, that rate you are going to receive. Then C is your dividend that you are going to receive in your future. This dividend is your future, this is your rate, and this is your growth rate. That you can see in this, G is your growth rate, and your dividend amount is what? 500. 5% is 5. So D1 we calculate with the help of G, because after 1 year, suppose if I show you on a timeline, okay, if today I am purchasing this, first year they are saying that you are going to receive 5. After that you are going to receive 5 plus 10% also you are going to see in this. After that you are going to see 5 plus 10% along again 10%. So this is the increase you are going to see when you are going to receive the dividends. So for that, what model you can use? That is your constant growth model. Okay, based on this, we are going to solve one question. Suppose XYZ Limited expected to pay a dividend 3 per share 1 year from now. After 1 year, you are going to receive 3 per share. So the dividend payments are expected to grow at 5% per annum. If an investor needs 12% rate of interest on his investment, what price of the share will be considered to be fair by him? Now there is an investor who wants to purchase XYZ company's shares. Company saying they are going to give dividend 3 per share, and this share, dividend amount will grow 5% per annum, and investor needs, okay, now as an investor, okay, suppose I want to purchase XYZ company's share. So as an investor, I also want something that acha, I want 15% return, I want 20% return. So that expectation of an investor is what? That 12% rate of interest. As an investor, I want 12%. So this is your R amount. That is 12% rate of interest. And you can see there is a growth of 5% per year, and this is the constant growth. So what model you can use for valuing your shares? D1 R minus G. See, D1 is your expected, and you can see here they have written that term expected. And if as an investor you purchase this company shares, they are expected to give 3 per share 1 year from now. Means after 1 year you are going to receive 3. So that is your D1 already after 1 year. R is what? That is your 12. G is what? That is your. So I'm writing in decimal format. I hope you know this. If you want to write in a fraction, you are going to write it as. If you want to write in a decimal, you are going to write like this. So 3 divided by C. If I subtract 0.12 minus 0.05, this will give me 0.07. So basically, if I divide 3 divided by 0.07, this will give me rupees 42.85. Okay, this is the true value. That as an investor, if I want to know the true value of these shares, that is 42.85. If company is selling for the same amount, then I am ready to buy it. If company is selling for rupees 100, then I am going to ignore it. If company is selling for suppose 35, then surely I am going to purchase this share. Because the true value, that fair value is what? 42.85. This is how we need to calculate. Chali, coming to next. If a company's dividend per share is 5, the required rate is 10% and the dividend growth rate is 4%. What is the stock price according to the model? Again, we are going to use that same model. Now, company is a per share. Okay. Now, company's dividend per share is what? 5. The required rate R is what? That is your 10%. And the dividend growth is what? 4%. Now, in this, we are considering if a company's dividend per share is 5. Okay. We are considering this as D1. So, what is the formula for your P0? Today's price is what? This is. So, what company is giving you dividend after 1 year? R minus G. D1, the dividend you are going to receive after 1 year, that is 5. What is the rate? That is 0.10. Growth is 0.04. So 5 divided by, this will give you 0.06. So 5 divided by 0.06, this will give you 83.33 rupees. This is the true value of the share. Okay, so as an investor, if company is asking for 300, 400, then I'm going to reject that offer. But if company is offering me the same share for 50 rupees or 60 rupees, then for sure I'm going to purchase it because their true value is 83.33. This is how we need to use your constant growth model. Okay. Next that we have is zero growth model. Zero growth model means the dividend per share stays the same from year to year at the value of t. There will be no growth. If they are saying 5, so every year I am going to receive 5, 5, 5, 5, 5 on. There will be no plus 10%, plus 10%, plus 10%. That is what zero growth model. Same constant dividend I am going to receive. So what formula I can use it here? P0 means today's price. P0 is equal to D divided by R. D dividend, R is your rate. Why not G? Because G is already 0. There is no growth. So G is already 0. So if you want to write it, you can write it. Otherwise, that is already 0. So R minus 0 is 0 only. Correct. Chali. So based on this, we are going to solve one more question. Suppose XYZ is expected to pay dividend of ₹3 per share 1 year from now. The dividend payments are expected to remain constant. That is 3 per share. Now, if an investor needs 12% rate of return on his investment, what price of the share would be considered to be fair by him? So basically, he wants to know the price of the share. Okay. So D divided by R. You can see G is equal to 0. So you can ignore it, or if you want to write, you can write it also. So D is what? Every year you are going to receive 3 only. And what is the return as an investor I want? That is 12%. Growth is 0. So 3 divided by 0.12 will give you ₹20. This is the fair value of my shares. Again, this is how we need to calculate. And remember one more thing. This first and second models are easy. Okay, but 2-stage H and 3 models, they are slightly different. And if you want to complete this model also, then you can join the class, because already we have limited time. So in that we have completed constant growth and zero growth. But covering 2-stage and 3-stage, this requires a lot of time. Correct. So you can enroll in our batches. Now, how you can enroll in our batches? You need to visit to Adda 24/7. You can search on any search engine. Then you need to click on this Adda 24/7. In this, all courses JIB, CIB, and your attempt is CIB June 25. Now in this, you can see there is a batch like Ekagrata and Focus. So these batches are your concept batches. Now we are going to launch these batches. Don't worry, and these batches will be starting from 21st Feb. So if you are a candidate who wish to clear in this CIB June attempt, then you can enroll in Ekagrata and Focus batch. This is your last chance. Okay, because after this, if you are wishing from concept clarity, then it will be quite tough for you. So try to enroll in these batches. But if you want one stop solution, then that is your CAIIB Mahapacks 2.0. In this, we are providing you the live online classes, mock test, ebooks, videos. Remember, when we are saying live online classes, we are giving you concept classes also, crash courses also. Along with that, we are providing you the revision classes. So this is the ultimate pack, means one investment will lead to all the access of every and each class. Now, if you wish to purchase it, you need to click on buy now, and you need to use one special coupon code. Otherwise, your discount only 78%. But if you wish to increase the discount, you need to use one coupon code, that is Y895, and you need to apply. As soon as you're going to apply it, you can see there is increase in your discount and it reaches to 8. If you purchase the same Mahapack from Adda 24 application, you are going to receive extra 1% off also. See, these benefits are for limited time. Use it wisely, okay? So that you are going to receive maximum discount, and the coupon code is Y895 and with double validity also. If you are not using this coupon code, there will be no double validity. There will be no 80% off. But for extra 1%, you can use the other 24/7 application. So with this,